All right, welcome back for another sub-series of the Share the Wealth show called Microfamily Millionaire, where I am documenting my journey, tips and strategies on while I'm on my way to becoming a millionaire with small multifamily real estate. So, one thing I wanted to talk about today are portfolio properties. So, let's say you find a deal that is, let's see, multiple, they'll say it's 21 units, but they're three 7 unit buildings, and they're not all on the same tax lot. And they are scattered maybe 2 or 3 blocks apart or throughout the city, right? These buildings have different tax parcel IDs, but the owner is selling them all together as one package. So it's 21 units total, but they are all not in the same building and they're not even on the same piece of land, right? So how do you do that? They're selling it as a portfolio. Should you buy it as a portfolio? How do you get the loan for that? One thing that you should consider, a lot of times banks and lenders may make you purchase each one of these properties individually. Like, so you would have to get a separate loan for each one of the three properties, even though you're buying them all at the same time. That can all be coordinated. That may be smart or it may be a hassle. And you have to just think about what your long term strategy is for the properties. Let's say you have this portfolio of three, but let's say you're able to finagle getting one loan. You found a bank that's going to do one loan for all three properties under one loan, right? Problem with that is somebody comes along in 2 years and wants to buy only your best performing property out of those three, and they're willing to pay a premium, and your returns will be crazy, right? But now you have one loan on all three instead of individual. So how is it that you can sell out one property from this portfolio when you went and got one loan? That is going to be a nightmare of paperwork to unravel. It's going to cost a lot because now you have to not only sell one out, you have to refinance them out to get the other two properties into a different loan by themselves and pull the one property that someone's interested in buying off by itself. So I don't know if it's a good idea to actually buy a portfolio of properties with one loan because now you're kind of stuck. So there could be upsides to that as well. Let's say now you're just dealing with one debt service. And if one property is slacking a little bit, it can get picked up by the other properties. But if you're doing your accounting right anyway, even though these will be if they were separate loans, they would be separate bank accounts. Hopefully, that's how you're operating your properties and keeping everything separate, because every building is its own business. So you can always transfer capital between you or from the building's bank account to like your LLC and then transfer it over to the next LLC. I mean, there's a lot of financial things that can happen. And I am not a financial advisor, I'm not an accountant, CPA, but you can move money around to make those transitions happen, not legally, because it's still legal, but with financial accounting practices that make it clean, right? You don't want to have commingling of funds and all that. So you can do that, even though it's a little bit more of a hassle, but I would not automatically assume that having one loan for multiple properties in a portfolio is always the best idea. Please make sure you talk to your accountant about that first, even your attorney, and seeing what legal ramifications might surround that. Because what happens with insurance if there's one loan? What if you want to refinance the property to pull out, or the properties to pull out equity, but one property is not doing as well? So you know, with commercial, is the value is all based on the net operating income. So if you have one property that's not doing well, so their valuation is lower, and you have another property that's doing really well, so the valuation is higher. Now that's messing up your valuation for the whole portfolio. And now maybe you can't pull as much from it as you would have been able to if you were looking at refinancing or cashing out one of the properties by itself. it just makes a lot more paperwork, I think, and struggles that are avoidable if you get the individual loan. So yeah, may do you have to pay a little bit more upfront because now you have to pay for closing costs on all these different loan products. Yes, but in the long run, I think it makes a lot of financial sense to actually keep these loans separate. Just something to think about. And until next time.